Hello, everyone, and happy Sunday. This is Spectertrader here with my market analysis for this week. So, taking a look at the markets recently, it's quite interesting to see that we have a risk-on moment these past few weeks, despite factors that would suggest just risk off. There has been a general risk-on moment across all asset classes, and now, it is too early to say whether or not this is a truly full rotation back into risk, as there is many that are highly skeptical of this rally. But one talking point is that there's a lot of cash on the sidelines with nowhere to go. Why would you buy bonds unless you think inflation is finished? Why would you lose money to inflation holding cash? Equities is the only route to go. Now, I wouldn't just buy any equities, though, because with high inflation and Fed tightening and interest rates set to rise, I would actually be looking at more undervalued tech, value stocks, or any company with pricing power that has a lot of cash and very little debt. Now, going into geopolitics, we see that Shanghai has had over 6,300 new COVID infections last Friday, with the eastern half of the city under tight restrictions. The Shanghai lockdown actually means that there'll be less demand in energy in the short term, as they are quite a large consumer of energy in the world, and also, there is signs of Russia signaling for possible peace, which potentially eases the supply side fears. So it's more of a 1-2 punch to the supply side and demand. Now, I do think that we will see a lot of volatility in energy for a while, not going away in the near term. But it will be good if energy could come down from these elevated prices, and it does not really bode well for the economy if it stays at these elevated prices for a long time, as it is historically correlated with recession. Now, if we take a look at the VIX is at its lows, recent lows, while the market is making new highs, which shows that no one is really worried at these levels and no one is really hedging. So that's quite of an interesting data point. Now, going into the Fed, many people think that the Fed is not going to let things get out of control and is more and this is also letting people get more comfortable with the idea of high inflation. Ever since the Fed has been saying that they have a playbook for this inflation issue, it seems to have eased much fear. The worst thing for the market, after all, is uncertainty. It appears that the Fed is talking about aggressive rate hikes. It's just the Fed talking tough. Now, you do see a lot of people talking about inversion, but that is the only pair that is the highest correlation with recession is actually the 10-year yield and a 3-month yield. But even then, since 2008, that correlation has been going down. So it's not a perfect predictor of a recession. Like, even if it does invert or teeters near inversion, it does not mean that we're certainly going to go into recession. And recession is quite a rare thing. I mean, the thing is, with signaling recession, it's quite easy to cherry pick this data. And for example, if the yield curve inverts and teeters on inversion in the course of a month and a year and a half later, we have a recession, then people will be like, wow, the yield curve signaled a recession, but something like that is not really any consistency in this, as it's really it's not a causal thing. It is just the yield curve itself is just the market signaling that they anticipate rates to go down in the future because they see some adverse set of circumstances that will hurt growth and tighten credit, where the Fed will have to cut rates. So you can see pockets of the yield curve where you see movements where there is this inversion, but that does not mean that there is any guarantee that there will be consistent signals of recessions repeatedly. And besides that, we could see that the real rates are still negative. So in the short term, it's not crazy to see rallies in stocks, because with inflation high, despite inflation being higher and mortgage rates being higher, you're still being subsidized to buy a house. Because if you think about it, the mortgage rates have been going up, but you still beat inflation if you were to invest in a house, if you're comparing it to the inflation rate. So yeah, maybe in the long term there'll be some concern where the Fed will have to suck up liquidity. But right now, besides the narrative saying that it's a hawkish Fed, the policies you could see are still very accommodative. And if the markets do all the heavy lifting for the Fed does not really have to unleash their super bomb and raise rates so aggressively. Another thing to look at is a euro-dollar futures curve. If you take a look at the euro-dollar futures in the report, the market is thinking that the neutral rate for the Fed in the long run is 2 to 2.5%, where the short-term rates already are at. So that really means that the Fed does not likely have to do much heavy lifting due to the markets already doing it for them. It's quite a good thing if the market can price in the tightening and the Fed does not have to engineer the market for themselves. And if the Fed could achieve this, then we can have that soft landing that they have been talking about. Yeah, so if you look at the euro-dollar futures, the market pricing for the December 2023 euro-dollar contract showed an implied yield of 2.235%. And traders say that this is a proxy for the Fed funds rate. So, and the Fed funds rate is the rate that the banks charge each other for overnight loans to meet reserves required by the U.S. central bank. That is looking likely to be that date is looking likely to be the peak of the Fed rate hike cycle, or it's called the terminal rate, with implied yields declining to 2.18% in March 2024, 2.125% in June, 2.095% in September, and 2.085% in December. The Fed officials estimate the long-term neutral rate, which is neither constricting nor stimulating on the economy, is 2.5%. So really, this is not the Fed funds rate is not really something that should be concerning at these levels. The GDP number that came out this week was 6.9%, which looked decent, but if you take a look at what made up the number, 77% of the GDP was made up of inventories, which generally means that the companies are preparing for inflation and storing up for the storm ahead. Now, when the inventory makes up most of the GDP, that is generally very bearish. I think most likely we'll have an economic slowdown based off the GDP data that has came out, but not necessarily a recession. So, going into the futures market, we could see that there was absorption on the offer side at the 4620 level on Tuesday. And for any business to have been done above it, it had to be neutralized that day, but it wasn't. So we ended up having a nice break of a mechanical level at 45.66. And we had an air pocket of low volume underneath that. And The level after that was the support, was 45.15. Now on Thursday, ES broke a very key level. We did break very slightly underneath the 45.15 level on Thursday, but we failed to really drive through 4,500 and 44.96, which was the next support. And we need to hold this support, or else it's really bad for the bullish case. For me, from a medium-term perspective, the line in the sand for me is 45.93. Ideally, we reclaim this level soon and hold above it, or else I'll be more bearish biased. And above, so another level of resistance that we have is 45.65, which is the recent breakout area that had failed on Friday, which I will pull up right here. Going into next week, we also have the 45.15 level again as another support, which it is a recent 3-day balance breakout area. So for recovery, we do need to get back above 45.65 first, and then 45.93, or else the longer we spend underneath it, we have a greater odds of seeing 4400s next. It was a good sign that we did not take out 45.15 and 4500 on Friday, but still we need the bulls to hold this level to prove that this is just a dip and not a bear market rally. So yeah, let's just see what happens going into the next quarter, as quarter one wasn't the greatest start to the year. The SPY ended down 5% and the NASDAQ down 9. So there is potential risks ahead for the market this quarter, from tightening policies to shrinking fiscal stimulus, inflation, or geopolitical risks. Based off studies in the past, if the Fed does not aggressively tighten and the economy does not enter a recession, then it is a possibility that the stocks can do well if all these factors do not hinder the momentum. But besides that, I would thank you all for watching, and I will see you guys next week. Thank you.